Christian Financial Advisors, Episode 109.
Welcome to Christian Financial Perspectives, where you're invited to gain insight, wisdom, and knowledge about how Christians integrate their faith, life, and finances with a biblical worldview. Here's your host, Christian investment advisor, financial planner, and coach, Bob Barber.
Welcome to our 109th podcast.
Wow.
That's a lot of podcasts, Shawn.
I know.
And there's something in here today. I can't tell what it is. It's all these cameras.
Well, yeah, this is our 109th episode, and we figured let's take the lens caps off, you know?
Oh, no.
This whole time has been
we
audio
have not.
only.
The lens cap has been on all this time.
I know. And you told me that you took them off, and it took us 108 episodes to realize that they were on the whole time. So anyway, welcome to our first actual video, not just audio, unless, of course, you're currently listening to the video or the podcast.
Exactly. Yeah, so if you're listening to the video, get this. You can go see really two good-looking guys.
Yeah, and we are super humble about it. So
got a good subject for today.
All right, hit me with it.
Investing during turbulent times.
Does that ever happen?
I don't know. Is it happening right now?
Well, it depends on when someone's watching or listening to this. But as of the time of this recording, most would probably say, yes, we're in some turbulent times.
We're in some very turbulent times.
Not just in the markets, but as a whole. Seems a little crazy.
And you know, as we've shared so many times in Ecclesiastes, it says there's a time for this, there's a time for that. I mean, there's all different types of times, and there's going to be good times and bad times. There's going to be times to heal. There's going to be times that you're going to get hurt. So, you know, but the good thing about, I look at everything from a perspective of, when it's bad, it's going to get good.
Yeah.
But when it's good, you got to be prepared for when it's going to get bad.
Well, everything goes through cycles. Whether it's the stock markets, the real estate market, which I wonder if there's anything going on with that right now, Bob.
Oh my goodness!
Everything goes through cycles. There are times of growth, and there are times of decline.
We'll talk about that real estate market here in a little bit. So today's podcast is called "Investing During Turbulent Times," and these are very turbulent times. And I think it's good to talk about what's causing these turbulent times. First. And
so I guess our first one.
Good outline in front of us help us keep along. Okay.
Our first one, we got the Ukraine-Russia war.
Yes.
There's the fear of escalation, possibly the use of nuclear hypersonic missiles. I mean, there's a lot going on with that. There's all the stuff with the Nord Stream 2 or Nord 2 for the pipeline. They've been billions of dollars been invested in this, and now it's just completely halted.
Yeah.
So
there's a lot that is a very big concern. And as anybody knows that's been watching the news, you know, Putin is kind of a madman. Yeah, and he's just very unpredictable. So that is definitely causing turbulence in the markets, and it's causing turbulence in our own lives.
Yeah.
You know, the second thing, of course, you can go to the grocery store, you can go take your car to the gas station. I mean, it's record high inflation. I mean, you know, that was really caused by all of this government stimulus.
Yeah, we had artificially low interest rates. There was the government spending. You know, like, we'll just throw more money at it.
Yeah.
It's not like it would cause a problem. But
so it just had too many dollars trying to chase too few goods.
Exactly. What would you say is a healthy inflation rate? It's around the 2 to 2.25%, right? Isn't that what the Fed usually targets?
Yeah, but you know, I don't mind an inflation rate just around 3 or 4% myself.
Yeah.
But yeah, where we are today, 7, 8.
Yeah.
And I think if you go really compare what you paid for things a year ago, it's more like 15.
Yeah, and especially for people who their income has not been increasing by, 10% plus per year, that can really start to hurt.
You know, we got the fear of the higher interest rates right now too, and the tighter money supply. And what I mean by that is the Federal Reserve, they've knocked these interest rates down so low to extreme lows. I mean, just up to about 3 months ago, you could get a mortgage and be at a 3% rate.
For a 30-year.
And I looked at it this morning for a 30-year. I couldn't believe my eyes. I was seeing 6 and 6.5%. It's double what it was just 2 or 3 months ago. And then the Fed was buying. They were putting $130 to $150 billion into mortgage-backed securities and buying all that. So they haven't even raised rates but one time.
So just by reducing that amount that they're buying back,
right,
as well as what was a 0.5%, right, or a 0.25% actual artificial change to it. Just between those two things is what has been causing all these changes, right?
Yeah, and where the mortgage market is tighter now.
Yeah.
So it's a lot tighter than it was. So there's the fear of those higher interest rates and a tighter money supply and what it could do to the economy, and the markets really overreact. You'll see the markets, and you'll hear this, never fight the Fed.
Yeah.
And so, and the Fed's for a long time has been saying we're going to raise interest rates.
Yeah.
Well, now they're actually doing it for some. The market's like
the market's like wait, you're doing the thing you said you're going to do.
Exactly, and now there's a real concern amongst many, including myself, of a major real estate bubble pop. That bubble's just going to pop.
Well, because that goes into the interest rates. It's just it's a matter of interest rates and price and that relationship. Where if your average interest rates are going up, it's just math. The prices will drop.
Well, the reason a lot of this is because I just want you to think of something. When we were at a 3% interest rate just a couple months ago, on $100,000, the interest is $3,000 a year. Okay, 3%.
Yeah,
easy.
Just real simple interest.
Now we're at 6.
Yeah.
Well, the interest of $3,000 at 6% is $50,000. 50,000 times 6% is $3,000 a year.
Or you've got to jump to $6,000 a year in interest.
So here's what's happened. What's happened is the purchasing power of 70 to 75% of the buyers in this country has gone down by half. So what is this going to do to the economy?
So all those people who were planning on, a certain payment that they were comfortable with, if all of a sudden the interest rate has gone from 3 to 6%, it's drastically reduced the end price that they can afford at that same payment.
There's only one thing that can happen. Either the interest rates have to come back down, which they're not going to do, or the builders are going to have to lower their prices.
Yeah, as well as other homeowners who are trying to sell.
Yeah, and I would have not wanted to buy a home a couple months ago because now you bought it at the peak. Okay.
So
what else? You like my fifth one?
Political leaders that seem incompetent to do their job.
Yeah.
Which in my opinion doesn't really seem like anything new. That's you.
Yeah.
But more so right now.
But that is a real cause of concern, and the markets don't like it. There's also their computer chip shortages that continue. By the way,
it takes a
the
while
Ford
to
Explorer
rebuild.
I ordered back in December finally came in. It's about to be in a week or two.
# not sponsored by Ford.
Yeah, that's true. That's true. But I've been waiting forever. But that's one thing that people really notice. I mean, you go by all the car dealerships and you just see very few cars on the
and for most people,
as far as new ones,
that's the purchasing a car. That's typically the second largest purchase most people make after buying a home.
That's exactly right.
But with chip shortage, we've been trying to ramp up. Most companies have been trying to ramp up their production in domestic. But building that manufacturing back up when it hasn't been in place, that takes time. So even though we've been needing to make a change, doesn't mean it's not like a light switch.
Yeah.
You can't just turn that on.
Yeah.
Now, once we get that up and running, however much longer that's going to take, it'll be great long term for us domestically, for the economy, but it's not a quick fix.
So we got the computer chip shortage.
Yeah.
Okay. And then the seventh thing on a real concern right now, of course, is the continued supply chain disruptions that are coming about.
Yeah, which is still continuing to be exacerbated with China. They made these weird changes where the ships that would come in to say our main ports like LA, a lot of times these semi trucks, they would be coming in with say an empty container, and they would swap. So the empty container would go back on the ship, and the full container would go on, and then they leave. Well, what's been weird is that China is not allowing the empty containers to come back. I guess it was with COVID or whatever. They didn't want to bring stuff in, and so what's happening is the truck drivers have to basically offload those empty containers, and then get in line to actually get a full one. It's basically causing unnecessary extra time wasted, and on top of that, then it slows the supply chain down because we're still trying to catch up.
Let's get to our last one because I have a feeling we're depressing people by now, okay? But we want to point these things out.
We do have some good news.
Yeah, we do. Of course we do. But there's also been the shortage of workers to fill the vital positions in the marketplace, even with unemployment at record lows. I heard just about a week and a half ago, You know me, I'm just on the news all the time that
Yes.
that there was about 50,000 more jobs than could be filled. So
Yeah.
that's a real concern. So what do you do during all this? How do you invest during these turbulent times? Because they're turbulent. But by the way, you know, turbulent times, I think people have short memories because turbulent times come along every couple of years. You know, it was just a couple of years ago when we were going through COVID and we went through a 2 or 3 month major turbulent time in the markets there. You know, it was back in 2018 we had some turbulence. Of course, we know 2008 was major turbulence, but there is turbulence. Turbulence is normal, and we'll come along in the markets every couple of years. But
you could argue it's a part of a healthy market that those things happen. You have times of growth, you have times of pullback.
Yeah,
that's just normal. And even Solomon said it first, I guess. There's nothing new under the sun.
Yeah, I mean, exactly.
All the way back then.
So the first thing, we're going to go through about 8 or 9 points here, and we're going to try to zip through these pretty quick. The first thing is, you know, look at what you're investing in. Are the companies you're investing in, are they needed to sustain a normal lifestyle? And, you know, I look at things like, are the companies, do they produce food, or are they in the grocery business, or clothing, shelter, technology, energy, utilities, healthcare, transportation? All those things that we use on a daily basis.
Yeah, they're not really going anywhere.
Yeah.
It's kind of like back in 2020 when COVID hit and everything was crazy and the markets dropped, 30, 40%, depending on what you're looking at. And shortly after that, within a few months, there was a lot of areas in the market, especially technology sectors, that had popped back up. And yet, for a considerable amount of time, energy was still vastly undervalued compared to what it was. But
now it's probably overvalued.
Right now, we're using electricity to film this. We still, even then and now, we need energy. So, those are great examples of things that they're not going anywhere, even though they might fluctuate some.
Well, things that you got to have.
Yeah.
Now, do you have to have streaming for your television?
No, but it's nice.
Okay. Well, we all know about a certain company. Just within the last week or two, depending on when you're listening to this, they're down 30 and 40% in just the last 6 months. So, you don't have to have TV streaming, but you do have to have shelter. You do have to have clothing, I hope.
Yeah.
Sometimes your son doesn't think that, by the way.
Well, it depends. Hey, if you're a surfer, or a pair of shorts, about all you need.
I'm just talking about the grandson. He's just so funny, and Shawn is my son-in-law, y'all. So.
Yeah,
that's why I can give him a hard time.
Yes, my son has a habit of clothing optional.
And another thing is during turbulent times, you really want to have a well thought out investment process, and
so a strategy, if you will.
Exactly.
Yeah.
And we have that. We have our 7 strategies on our website. But I'm amazed.
Hashtag shameless plug.
There you go. Website, by the way, ChristianFinancialAdvisors.com. But I'm amazed at how many people don't have an investment strategy, Shawn. They just don't have one.
Yeah.
So we have one that's
I've been
laid
in those
out
meetings too,
and thought out, and it's not based on emotion. You don't base this on emotion. Yep. And number 3 is understand that turbulent times are nothing new. Mm-hmm. They're always going to come along every 2 to 3 years, but it always feels like when you're in the middle of it.
Yeah.
I know right before you came on today, you had a call from and this is an older client, and all of a sudden they're just like, I want out. And this has only been going on for 2 or 3 months.
Yeah.
And the average bear market lasts
11 months.
11. Okay. All right. So we're already 4 months into it.
That's based on the last, as of this year, it was the last 73 years. Average bear market's about 11 months. But we had one as short as, what was it, 2 or 3 months?
Oh, well, that was during COVID. Yeah. It just came right out of that. Do you like my number 4? That is really big.
Yes. Keep emotions and feelings out of investing, which is exactly what we're talking about with the plan. You need to have a plan that you can stick to and execute, not just when things are going great, but when you're starting to panic. Don't let your short-term emotions and panic or fear dictate your long-term strategy. Emotions
should have nothing to do with investing, bottom line. Yep. Not a thing to do with it. You just have to keep your emotions out of it.
I know for us, we usually have to pray for that. We're getting a little bit, it's like, okay, let's just stop for a second, let's pray.
And we have the emotions chart that, by the way, we have on our website too.
Yes.
The emotions chart that helps remind us when you're getting real emotional and you think it's doomsday and it's just time to throw the bag in, you know what? A lot of times that's the best time to invest some more.
Yeah.
But number 5, behind this emotion, because there are people that they prey on it. They prey on these emotions, and that's professional doomsayers, however you want to say that.
Yep.
And, you can say doomsdayers or doomsayers. You can say.
I think it's doomsayers is the official word. It's doomsday. So.
Yeah, exactly.
Yeah.
But they're out there, and they make a living from selling fear. They take advantage of people during these turbulent times like we're in.
And if you're watching this in 2022, near the time of this recording, it is when the sharks and the predators really start to come out, because people are scared. If you've been in a couple months or so into the markets and things haven't been going up, they're like, oh, well, let me dangle this fruit in front of you. I have the solution for you. All you have to do is buy now.
That's the truth.
So
that's the truth. And they just take advantage. They're selling high commission products like gold and silver and high fee indexed annuities. Or even subscription-based newsletters that you have to subscribe to. So these professional doomsayers they're all over social media. They're all over the internet. They're in television, and they're mailing out thousands of seminar invitations right now. I'm getting them. I get them.
Those free steak dinners to try to lure you in.
There's a free steak dinner. Come see us. And you know what? Those seminars, Shawn, to put on one of those seminars costs thousands. They'll send out like 10,000 invitations. Right? There's $10,000 right there. And then they're buying all the free steak dinner. So they're looking at that seminar.
So of the 10,000 people, they had a couple hundred, maybe 100 people, if that, maybe 30.
They'll have 30 show up.
But they show up. They caught a few.
But still, there's possibly another 2,000 or 3,000 in food they're going to have to pay. So now they got 13,000 or 14,000 sitting in that seminar.
And they only need one or two to sign
high
up.
commission.
And sign now, you get a bonus. If you sign now, you get a bonus. Like, no.
We had a call like that yesterday.
I know. No, the person selling it to you gets a bonus. And you're stuck with something for 10 plus years. You can't touch it.
Yep. So let's get on to our 6th point. Our 6th point is, during turbulent times, instead of looking at it like a time to get out, hey, just look at it like an opportunity. This could be a great opportunity. So you have to go against your emotions.
Right.
And like today, it's a pretty big down market today. And I'm looking at it closely, but I'm thinking it could be a bigger down market in a couple of weeks when they actually do raise rates that they're talking about in May.
But part of that is the strategy too. See, our strategy allowed us to move some of the capital that would have been in, say, equity, move some of that to cash and the fixed income. So when we get that strong buying opportunity, we actually have some capital to do it.
And the reason we did that is because back in September and October, when emotions and everybody wanted to get in, buy, that was the time I said, you know what, we need to take some off. And so in our moderate accounts, we went from a 60 to 65% exposure in equities and stocks down to 35%. And then we entered about 6 or 7% in a couple weeks ago, and I'm looking for enter in another 6 or 7%. But I'm looking at that as an opportunity, not a time to sell, but a time to buy.
What's that phrase that you say? It's the pigs get fat and the hogs get slaughtered.
Yeah, that's true. Yeah. And that was during the up times. So just keep that in mind. Look at it as an opportunity. So when we had that one client call today and they're in a panic, say, oh, you want to invest more?
Yeah, we kind of use those calls, or when people are thinking like, I think I need to get rid of everything. You and I are looking at that as, might be on the verge of some good buying opportunities.
Yeah, exactly.
When most people are starting to panic, that's a good sign that it might be a good buying opportunity.
And you got to really, during these turbulent times like this, you got to stay cautious. This is our number 7 point that we want to make. Stay cautious of the tendency to chase returns, because even during times like this, you're going to, there's some things that are way up. Energy is way up. Well, it's not the time to get into energy. When it's way up.
You missed the time to get into the energy.
So there's that point of wanting to chase it, and that's just a normal tendency. You hear somebody else is doing so great.
Right.
But be careful of buying high. Don't buy high. Buy low.
Well, it's that the grass is always greener somewhere else. Except it's not, usually. So.
Yeah, well, that's what cows find out, isn't it?
Yeah.
They get on the other side of the fence, they're like, I think I want back now.
Yeah.
All right. Number 8.
Stay patient. Stay patient. Stay patient.
Stay patient.
It is not a time to panic.
That's exactly right.
If anything, if you're thinking of panicking, like we said in the previous one, it's probably a good time to buy.
The fruits of the Holy Spirit are love, joy, peace, patience, kindness, and gentleness, and self-control. patience is a good thing. And this is something you really got to exercise during turbulent times, is stay patient. You know, we've said that a lot of times now, so we'll go to the next point.
So, number 9 is think long term, like 3 to 10 year increments, not 3 to 24 months.
Yeah. See, so what's happening right now? We see some panic going on. It's been going on for 3 or 4 months.
Yep.
They're thinking.
And people think,
thinking,
well, this is the new normal. It's just going to continue to go down.
Right. It's never going to come back again.
Yeah.
We're all doomed.
Never again. Yep. My.
You know what? If Jesus wants to take me back today, I'm ready to go, though, brother.
Well, it reminds me of I talked with a client about a week ago, and they were asking me like, well, what about the economy? Like, what about if we lose all of our currency and the government collapses? My first thought was, well, then what does the money and the investments matter anyway? Like, I mean, do you have canned goods in a bunker? I mean, because that's going to be a whole lot more useful than buying a bunch of really heavy, pretty metal like gold, or worrying about whether or not the currency is going to be useful.
And what did Paul say in Philippians? I've learned to be content in all things, whether well-fed or hungry. The contentment comes in Christ, and it's not going to come in anything else. And so I hope you've enjoyed this today about talking about investing in turbulent times, and we want you to know that Shawn and I are here along with our staff to help get you through these turbulent times. They're tough right now, and feel free to give us a call at 830-609-6986 or go to our website. There's a lot of good resources. Go into the Education Center under articles, and you'll see a lot of great weekly commentaries. And we had our webinar we did about a month or so ago, and those are time-proven principles and a lot of great charts that you'll want to see.
Plus, there's the other as of now, the other 108 podcast episodes on various topics. So those are free. Yeah. Also,
you just go to Christian Financial Perspectives.
There you go.
Don't you love it? The sign right behind us.
Yeah.
By the way, those that are listening by audio don't see that, but
yes, there is a sign. Bob's motioning towards the sign. But one thing I'd like to say too that we would use here is hope that Jesus is coming back tomorrow, but plan like he's coming back in 1,000 years.
Huh? You know who said that?
No, who said that?
Chuck Swindoll. Thank you. That's all for today.
Bye.
We invite you to listen to all of our past episodes covering many financial topics from a Christian perspective. To make sure you don't miss any of Bob's upcoming episodes, you can subscribe to Christian Financial Perspectives on iTunes, Google Podcasts, Spotify, Stitcher, or Amazon Music. To learn more about integrating your faith with your finances, visit ChristianFinancialAdvisors.com or call 830-609-6986. Investment advisory services offered through Christian Investment Advisors, Inc., DBA Christian Financial Advisors, also known as Christian Financial Advisors Management Group, a registered investment advisor. Comments from today's show are for informational purposes only and not to be considered investment advice or recommendations to buy or sell any company that may have been mentioned or discussed. The opinions expressed are solely those of the host, Bob Barber, and his guests. Bob does not provide tax advice and encourages you to seek guidance from a tax professional. While Christian Investment Advisors believes the information to be accurate and reliable, we do not claim or have responsibility for its completeness, accuracy, or reliability.